Trade wars, recession fears, a looming Fed decision. With all these macro concerns top of mind in the market right now, how are traders playing this environment? Danielle Shay is the director of options and a trading specialist at Simpler Trading. She joins us now to discuss. So Danielle, markets hitting a new high yesterday, on track for another record close today. It's hard to be short or bearish when you're at all-time highs, but are you particularly bullish right now with the market setup?
After the news over the weekend, first of all, I would say that this has significantly improved the macro condition with President Trump coming to some agreements with China. So for that reason, it did make me a little bit more bullish. But the problem is right here when we're at new all-time highs, the S&P does have a tendency to pull back after that, especially because so many people are already long.
Now, you say with earnings season a few weeks away, as an options trader, you love this time of year. You've got a couple of weeks where you're not going to get any new news on companies, I guess. What about the options pricing right now makes you so interested in this environment?
So what I'm really hoping for right now is a little bit more of a pullback in the market, especially after the gap up that we saw yesterday, because I love to trade the run into earnings. So like you said, as an options trader, part of the way that options are priced is based on their implied volatility. And when companies are reporting earnings, the implied volatility of the stock travels higher into the earnings report. So as an options trader, what we like to do is we like to buy those options about 2 to 3 weeks prior to earnings to capitalize on both price and IV trading higher into the earnings reports.
Danielle, one of the areas you say you're focused on right now is the debt bubble. So walk me through your investment case on this, because as you know, we've seen more and more people in debt, whether that's through credit cards, mortgages. I mean, walk me through your case.
So right now we have a situation where, number one, we have incredibly high levels of debt. That includes consumer debt, we have mortgage debt, credit card debt. We also have a pretty strong economy, so people are confident to spend money on credit cards. We also have low unemployment. And so what that means is that people have money, they're spending it, and we have a society that thrives off of e-commerce in the age of Amazon. So we can't buy things in cash, right? So we have companies like credit card companies, online payment processors that are really thriving right now.
Hey, Danielle, Brian Chung here. So tell me a little bit more about those names. So I see on your list you've got PayPal, you've got Ally, American Express, Discover. I thought that these types of financial services companies are supposed to be really sensitive to interest rates, given kind of where we are in this change of Fed tone. What bakes into your thesis there?
So on this list in particular, I don't have the actual banks like JP Morgan, Bank of America. What I'm looking at are more of these obscure names. So Ally Financial, this is a company that really speaks to millennials, and this is an online bank. Millennials love to do things online. They love to buy things online. I also like Shopify. Again, this is in the e-commerce space. PayPal has Venmo, which is huge with millennials. So these are a few different names, and then you do also have credit card companies in there, American Express, Discover, MasterCard, and Visa. If you look at these stocks, you will see that they're incredibly strong, both technically and fundamentally. And every time the market dips a little bit, they rally exponentially after the fact, and I'm looking for them to do that this earnings season as well.
All right, Danielle Shay of Simpler Trading, thanks so much for joining us. Have a great holiday.